they're also really short.
They're long and variable is what they are.
Are they?
They are.
Okay.
I'm going to quote the Fed. And also, when I hear the conversation about supplies and pricing, we're also looking at Greenspan's favorite indicator, vendor deliveries. And that's shown the greatest improvement going way back before the financial crisis. So the thought that there was pricing power because your goods were stuck on a container ship in the Pacific, forget about it. They're here. They're actually piled up in warehouses and on shelves. And when you look at inventory to sales, they're off the charts high. The only way to clear them in an environment where the consumer is clearly cutting back, going down brand, and is stretched, is to cut prices.
That's good. Can you say the same thing about services?
We'll see. I think so.
Isn't that the big question, though? Forget the goods argument.
I think so. I think just the cost to finance travel, leisure, all of those things on your credit card, which is what is happening. That's why revolving credit usage has gone up so much. It becomes punitive after a while. It's just not sustainable.
Bob Michael at JP Morgan Asset Management alongside us on Fed decision day, the 25 basis point hike behind us. No big changes to the statement. The news conference with Chairman Powell begins in about 16 minutes' time. Joining us now is Citi's Andrew Hollenhorst alongside Jim Bianco of Bianco Research. Andrew, you've had the benefit of extra time to go through this. Your take on what we learned 15 minutes ago.
It's interesting. It's interesting because of what did not change. This seems to have been very carefully put together so as not to send a dovish message like Diane was talking about. Really notable, I think, that the Fed could have taken the opportunity to say, headline inflation has come down, core measures are still elevated, but they left that statement unchanged. It still just says inflation is elevated. On the growth side, what was modest growth is now characterized as moderate growth. So just the tiniest inkling of a little bit of hawkishness that's creeping into this statement, at least relative to expectations.
Some of that little bit of hawkishness on the street, folks, came from Jim Bianco, who joins us right now in Chicago. Jim Bianco, I look at where you are and the bombshell you had a number of weeks ago of saying maybe we're a little more sticky than we actually think we are. Where is Jerome Powell's presumed R-starred path at this press conference? The zeitgeist is he's down to 2%. Things are normal. We're going to get back to normal. I'm going to suggest you disagree with that.
Yeah, I do. I do think that we might be on a year-over-year basis looking at the lows of the year in inflation, in June. And that we're going to see there's going to be a big base effect for the rest of the summer, and it's going to start to drift towards 4, and we'll be lucky to be back even close to 3 by the end of the year. And that will bring up the big question is the long run, rate of inflation, is it 2 or is it 2.5 or 3? And remember, the Fed has already told us that neutral rate is 50 basis points above the long run inflation rate. So if it's 2.5, then neutral is 3. And if the yield curve goes back to some normal level, which is around 150 basis points, you're talking about a fair value for the 10-year at 4.5. And we're at 390 right now. So we're a little bit low. And it all comes back to this whole argument about inflation and where's inflation going to go. And I've been arguing, the big fancy word, that this is a post-pandemic economy. That means that all the models on how inflation are going to work haven't worked since 2020. Right. And we have to write some new models on how it's going to work. Work from home being one big thing about how major that the labor market has changed, and a lot of other things too, like with the supply chain. And I think we're going to wind up with stickier inflation.
And Lisa, this is critical because this is what our booking team, we've got the morning crew and the afternoon crew that do it 24/7 for us. And to see the setup here of Hollenhorst, Michael, and Bianco and the collegial disagreements they have is the heart of the matter, and how it rolls back over into whatever we're going to make or lose in the stock market.
Which is the reason why I'm kind of shocked that this was an 11-0 decision. There was no dissent.
I agree with that strongly.
Given the fact that there are such divergent opinions.
This delusion of unanimity is I don't know, the British do this better than we do.
Well, I guess that's what I would ask you, Andrew. Do you think that it undermines the Fed to have unanimity at a time where there clearly is not unanimity in markets or on the Fed?
Look, I share with you the surprise that we would have no differences of opinion at this point. I think Powell has been somewhat masterful in terms of getting these decisions to be unanimous. But we saw that sometimes coming at the cost of clarity. I think that's what happened in June, where we had this strange decision not to raise rates, but to signal that it would be appropriate to raise rates another 50 basis points. So as you try to keep that committee together and get unanimity, it's a little bit troubling in terms of getting clarity in terms of the communication.
Bob, your take on this in terms of whether it's helpful or harmful to have unanimity at a junction that is clearly so fraught with disagreement on the street and at the Fed?
I don't think the unanimity is the accurate portrayal of what actually occurred in the meeting, and I'm dying for Bullard to go into public life into private life so that we can ask him these questions. I think what they did is they locked arms. As Diane's pointed out many times, they are concerned about financial conditions easing. This is another way to try to stop that from happening.
I look, Bob, at this. I can just see you with a speech with Bullard down at Purdue. What a debate that would be right now as he moves from the St. Louis Fed to Purdue. That goes to the dots in the dispersion. This was a Fed. Let's speak for those that don't keep score on this, like I don't keep score on this. Was this a dot-free meeting? How important is the setup to the next dispersion, the next theater of dots? Or are we beyond that?
We're living in an AI world now. What are we doing? Not doing dots and summary of economic projections at every meeting. Let's do it and indicate more about what the Fed is thinking. I think
you want more transparency.
I
if you're going to
just
do it,
want to know, and I think particularly, not usually, but after the last meeting, we've all talked about what were they doing? They didn't hike in June, but they indicated another 50.
That was odd.
If I were Mike McKee, I would ask Chair Powell, what about the dots in the summary of economic projections from the last meeting? Do you still stand by those, or would have anything changed?
Well, it's unclear which dot belongs to which policymaker. Bostic might have been one of those that would dissent today. Bostic doesn't have a vote on the committee at the moment. Bullard doesn't have a vote on the committee either. The Board of Governors, that would be where my issue is, because the Board of Governors, even if they believe that they shouldn't be doing one thing, they all vote as a committee, as one. So I just wonder, Andrew, how much we should read into the lack of dissent at today's meeting, and that maybe the September one is the one where it gets a little bit more fiery.
Yeah, I think it's definitely the case that there's a lot more going on behind the scenes here in terms of some disagreement. We saw some of that in the minutes to the June meeting. So there are real differences of opinion. And I think, like Diane, like the others were talking about earlier, this could really get interesting in September. In September, they'll have to make a decision. First, whether to hike rates. I think they probably won't because the inflation data has been softer. But then what do you do with those dots? Are you still showing that you're going to hike again this year? That would imply a hike in November. Are you then indicating that that's the last hike of the cycle if we see inflation picking up further? And I think that the risks are that it will as we get towards the end of the year. So it gets really tricky as they get to that September meeting, and then December, dots again. Are you showing no further hikes? Are you showing cuts? What do financial conditions do with that?
Jim, come back in here because you were talking about how models are broken and they're not really forecasting inflation in any kind of accurate way. What is the compass for the Fed? Do we have a clear sense of what data dependency means in the post-pandemic era where suddenly the data is not a reliable forward-looking indicator?
To be frank, no, we don't. And that has been one of the bigger problems, is that in a data-dependent world, what the Fed is trying to do is they're trying to divorce themselves from any theory that of how the economy and inflation is supposed to work, and they're supposed to react to the data. And then we get what we've had in the last 2 months. They paused in June. We got a big miss on in the inflation report. Year over year went from 4 to 3, and then they hiked. And so I'm not exactly sure why they paused and why they hiked and what they're going to do next based on their recent action, which is why I would underscore what Bob said, that, you know, Mike McKee's got to ask, what are you doing? And what is driving these decisions?
Right.
You pause, and then we get good inflation data, and then you hike. So there's a big confusion going on out there right now. And it's all part of the modeling that we've seen in the market. It's been very difficult to figure it out.
I want to set up one question here and give it back to John to get to the press conference in 6 minutes. I want to go to Bianco and then Hollenhorst, and then Michael here. I want to know your 12-month forward real GDP as you also violently disagree on inflation. Jim Bianco, 12 months forward real GDP. What's the statistic?
About 1.25 or so.
Okay, Hollenhorst?
I think we will have seen a decline. I think we'll have seen a recession by then, so we'll be sub 1% GDP.
Feroli Casman, what do they say? We'll fold it in.
I think we'll have passed through -1.5% to -2% real GDP.
This is not, John, in the American zeitgeist right now. The combination of those three opinions wrapped around their different inflation outlooks, this is removed from Meta, removed from Google.
We can't let them go just yet, Tom. There's still 7 minutes before the...
No, I know, but you're going to, I got to get back to Tottenham. I'm just trying to see what the future is.
You just want me to speak for 7 minutes now.
Yeah,
until the
I
news
got to read about Tottenham.
As you were talking about that, I was noticing Mercedes-Benz raised their full-year guidance.
Yeah.
I'm just sitting there thinking, hike again,
Yeah.
50 basis points. Mercedes still getting it done.
Coca-Cola too.
Yeah, Jim, let's talk about that, though. In all seriousness, who's paying these high rates? Where are they biting?
That's a good question. I think that they're biting at the business level, that they're wanting them to pay higher rates. They're definitely biting at the residential real estate level. You've seen a wholesale change in the way that the residential real estate market, existing homes don't move, and we've been trying to fill the gap with new construction because we've got a multi-year low in the volume of existing homes. So they've been biting there as well. Where they're not biting, by the way, seems to be in the cost of capital in the stock market. That doesn't seem to be bothered by it at all. So it's unclear as to where it is, and that might be leading to an idea that maybe all we've done with a 500 basis point plus rise in rates is just pretty much track neutral, and we're not really that restrictive, which is why we're not seeing these high rates hurt the economy as much as we thought.
Bob Michael, what would you say back to that?
I think it's biting in a lot of places. I think it is biting in the corporate world. You look at bank loans, defaults are rising pretty sharply. You look at the private credit markets, talk to people in there are real tremors there about what's happening in terms of exchanges and extensions. You start looking at, we didn't talk about central business district office space. That's still out there, unoccupied. That's owned in places. We saw that in Goldman's earnings. That has yet to be reconciled. So it's biting hard. We talked a lot about the consumer. They are really struggling.
Would you like to talk more about Goldman earnings? No, take a pass on that. I thought you might. Andrew Hollenhorst. Bob went there.
Hollenhorst.
Bob went there. Come on. Bob went there.
Oh.
I said Goldman. No. Andrew, I think we need to spend a bit more time talking about this. Just how much of the disinflation that we've seen recently is a consequence of the tightening cycle of the last year? How do you know? How do you identify that kind of thing?
Well, I think that's partly why the Fed's in a little bit of a difficult position here, because they've taken some credit for some disinflation that they did not have a lot to do with, which is the decline in energy prices, which is the decline in food prices. And then we're seeing, as we head into this meeting, we're having very large daily increases in gasoline prices. So it's certainly not going to feel to a lot of people like inflation really has been conquered. Now, somewhere where they do have a direct effect is on the housing sector, shelter inflation. And again, though, I would raise a caution there that we're kind of in this narrative that shelter prices are slowing, and they are. There's a lag that's introduced into the way that the data are put together. So those shelter prices will slow in official inflation statistics, but look at the reading from Case-Shiller. Look at what we're seeing in the real-time housing price data. Those house prices are rising quickly now. So there's some real upside risk to inflation, which would kind of go back to Jim's point that maybe 5%, 5.5% policy rates are the amount of restraint on the housing sector, at least that we thought it was going to be.
So I promise you this really is the final round of questions for all three of you, with the news conference about 3 or 4 minutes away. We need to get your questions for Chairman Powell. We touched on it briefly. You don't get to repeat that twice. Jim, what would you ask the chairman today in about 4 minutes?
Basically, what has been driving the decision-making to pause and to hike? I kind of said that earlier, but it does drive at the confusion as to what is really on top of mind for the Federal Reserve.
Andrew, what about you?
I would ask about the rebound in the housing sector, prices, growth, upside risk to both.
Well, Michael?
I'd ask what range of inflation and growth metrics are they using, and what levels would they look at for them to, one, pause permanently, and secondly, cut rates?
What would they tolerate? I've heard that from PIMCO, that maybe 2 point something. They'd be happy with that. They'd be okay with that. Does that resonate with you, 2 point something?
On headline, for sure, as long as the trend is headed down.
Jim Bianco, Andrew Hollenhorst, to the two of you, thank you. Moments away from that news conference with Chairman Powell following a 25 basis point hike from the Fed chairman. Bramo, it's almost question time, and you can hear from the panel in the last 20 minutes, bit of confusion over why they paused last time around, why they hiked this time around, if they are truly data dependent.
What data they're looking at, what their model is right now to gauge out inflation going forward, what their threshold is, as Bob was saying, to hike or to cut. We don't have a sense of any of these things. The model is, come on, we're looking at it. And there's Supercore and
Everyone was high-fiving the Fed a few weeks ago when we got that inflation data.
Yeah.
It was like victory lap time, Bob. Victory lap. People talking about a victory lap for the chairman of the Federal Reserve.
If you step back and look at growth and inflationary pressures, they are moderating. They should just put it in park and come back in January.
And do a victory lap?
I don't know about
I
the
feel that
victory
feels
lap.
too premature to me. That really does. One print, TK, and start celebrating.
This has been a fascinating discussion. Thank you so much to our team for putting together this just brilliant conversation, collegial disagreement. The common theme here from Marquette academics to UCLA academics to University of Pennsylvania academics is this is a press conference without theory. And I know I'm going to get pushback on that from Mike McKee and others, but off the pandemic, they're flying blind. And Bob, I would say they're as data dependent as we've ever seen.
Yeah, I think so.
Ever.
Well, look, I think that you are right that this is perhaps a theory-free Federal Reserve that's still trying to hew to some of the theories that underpinned their role in all of this. I would argue one of the biggest questions, John, is whether tightening has the same effect on an economy that is not showing signs of slowing down. To your point, the lag, the variable, long and variable lag.
Super long.
Super long,
really
but,
short.
But also variable.
I've got
so
no
then
idea.
how do we then talk about the efficacy of what they're doing?
Lisa, they don't know, which is why they're in the risk management business, and they've got to work out what is the biggest risk, cutting too soon or holding too long. And that's really, really difficult to do. I think it's easier to say we need to cut because we've gone too far. It's harder to say these disinflationary trends are on their way back towards taking us to a sustainable path to 2%. That's a much, much bigger call.
I don't know the answer to what's the biggest fear, inflation or recession. We don't know. And what you hear is from everyone on Wall Street, a different answer.
Let's go through the scores going into this news conference with Chairman Powell, who just enters the room. Your equity market negative 0.2% on the S&P 500, following a 25 basis point interest hike from the Federal Reserve. Here's the chairman of the Fed.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 0.25 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture, and starting with we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance. Including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermeeting period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder from your perspective, if that continues, if we see growth not just stabilizing, but performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looked good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now, after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you were really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the 2 risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And, you know, we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and you know that's the thing we really need to avoid and will avoid.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to look. I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has repeatedly proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is the growth rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this SLOOS will say.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the reversal, the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
I see. And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
Well, I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last, in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike, and the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things, and we'll keep an eye on them. But really, that's something that's handled at that level. And not,
Victoria. Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates, or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down, and we're comfortable that it's coming down, and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high 2s, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for a recession. And I'm wondering if the staff has changed its view on the likelihood of a recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market. And that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions. And consistent with having a soft landing, you would have some softening in labor market conditions. And that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Jeff. Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So, in effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt, but people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Bank of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point, and how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized. Capital and liquidity remain strong. Aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down? What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle-class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today, the decision was, of course, unanimous, and the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, was there doubt? I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks. The dollar, the stock market, et cetera. What does that mean for the Fed in being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So. To continue it, you depending on where you are in the cycle. So there are two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Let's go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. And I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance, or lack thereof, right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed-rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now. And there are people coming in. A lot of the buyers are first-time buyers coming in at buying it with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain, safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so, looking at what we know now.
Thank you.
Thanks very much.
That's a man who wants to get out of the room. Live from New York City this afternoon. Good afternoon. That was Chairman Powell down in Washington, D.C., wrapping up the Federal Reserve News Conference following a 25 basis point hike. Alongside me, Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. Special coverage of that decision just to work through the price action. Going through the news conference, initially a pop in the equity market, then it faded. I'll get to the why we got the fade in just a moment. The equity market right now is negative by 1/3 of 1%. Guidance for the next meeting. Make of this what you will. It's possible we'd raise or hold in September if the data warrants it. Are we restrictive? This far more interesting. The FOMC believes monetary policy is restrictive. Policy not restrictive enough for long enough, though. The real Fed funds rate is at a meaningfully positive level. On the economy, my base case is achieving 2% inflation without big job losses. He goes on to say the Fed staff no longer forecast a recession, but on CPI, Lisa, and this is when the equity market started to fade, I don't see inflation back at 2% until about 2025, so like way out in the distance.
This was Operation Say Nothing, where you basically repeat data dependent over and over again, but didn't say which data, and then you basically had a little bit for everybody, basically saying they are concerned about inflation, but recognizing that inflation has come in somewhat. This was Operation Do No Harm and say nothing and get out of there as quickly as possible, which you just did.
Highly repetitive, sometimes tedious.
Yes.
In the bond market, yields were higher going into this decision, lower following it. The two-year yield is down, Tom, by about 3 or 4 basis points in the bond market right now. TK, 483.91.
Some yield moves. It's good to see Gina Smilik of the New York Times pulling the Barbie movie here to give us the spirit of the American economy. January 31, 2024. Is he going to have a Lagarde-like press conference first of the year for the Fed, like tomorrow's Lagarde press conference if he gets a GDP slowdown, as we heard Bob Michael and Andrew Hollenhorst talk about. I'm fascinated about the luxury he has right now of a buoyant American economy, and if that drifts away, I'm not predicting that, but if that drifts away, John, is it Lagarde-like in January?
He is predicting it won't drift away.
Yes, very much.
The Fed staff are saying no recession in their forecast. Germany is living one currently. On the balance of risks around the economy, take a listen to what the Fed chairman had to say.
It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not. But as our stances become more restrictive and inflation moderates, we do increasingly face that risk.
If you asked that question 12 months ago, the answer was obvious. What's the biggest risk right now? Doing too much, doing too little? They would have told you straight off the bat. The biggest risk right now is doing too little. We need to hike 50, go even more than that. TK, the further along you get into this journey of Chairman Powell and co., the less obvious the answer to that becomes. And we're at that point right now.
We're post-pandemic without a theory. And if you're at Berkeley taking your PhD, maybe you can figure out a theory post-pandemic, but I don't see it. William Dudley joins us now. He's a former New York Fed president, has the immense advantages of years with Ed McKelvey doing market economics at Goldman Sachs. We're thrilled that Dr. Dudley could join us this morning. Bill, we got to wake everybody up after a summer press conference. You ancient past, Bill, this is 20, 30 days ago. The great U.S. Treasury bond rout is far from over. What I have not heard today is a discussion about higher interest rates. What is your belief that we could see higher interest rates?
Well, I think that Chair Powell made it very clear in the press conference that he doesn't see the need to go that much further. The very fact that it's sort of meeting now tells you that he thinks that, maybe there's one more rate hike, maybe there's no more rate hikes as we go forward. But that's a very different story than what does that mean for the bond market, because bond yields are low relative to short-term interest rates. I think there's a number of reasons why bond yields could move higher. Number one, inflation is probably not going to average 2% over the next 10 years. It's probably going to average a bit higher because the Fed has an asymmetric regime where when they miss inflation to the downside, they try to offset that with misses to the upside, but not the other way around. Also, if you look at the savings investment balance, it's not as favorable now as it was before because we have a lot more investment programs motivated by Biden administration policies. And the savings goal is also affected by the very large fiscal imbalances that the U.S. is likely to run for many, many, many years. So that implies that perhaps the neutral federal funds rate consistent with neutral monetary policy is a little bit higher than in the past. And then lastly, the risks are two-sided now for the bond market. Before it was all about I could hold bonds, and if we ended up in a recession and the Fed got stuck at the zero lower bound, the bond market would protect me. But now we're a long way from the zero lower bound. So the risk of getting stuck at the zero lower bound seems very diminished at this point. And the risk of inflation being sticky, I think, remains very relevant to the bond market.
Bill, we had an article at Bloomberg this week, folks. John Authors and Isabel Lee reported on the strategy world and how absolutely it's brutal has been for Wall Street strategists. Bill Dudley lived this at Goldman Sachs years ago. How clear is the Dudley crystal ball right now, Bill? What's the vision you've got? Are you making it up as you go?
Well, I'm a lot less clear now than I was, say, a year and a half ago. I mean, at that point, it was very clear that the Fed was way behind the curve in terms of the need to tighten monetary policy. They were going to have to go to restrictive, and they're going to have to move fast to get there to keep inflation from getting totally out of control. Now they're at a restrictive setting, and so the question is, how high do they have to go to be sufficiently restrictive, and how long do they have to stay there? And I think, they've been the economic news has been breaking in a favorable direction in the sense that they're getting quite a bit of disinflation without actually affecting the growth rate very much or without actually putting a lot of people out of work. I mean, the fact that inflation's come down and the unemployment rate's still 3.6% is really good news from the Fed's perspective. But my own view is, I'm still where I was before. I think the Fed's going to have to be, tighter for longer, and I think they're going to probably emphasize the longer piece. If you look at their forecasts, they don't see inflation getting back to 2% until 2025. So they think the process still has a long way to go, and I agree with them.
Bill, how important do you think it is that essentially this is a Fed no longer giving forward guidance?
Well, I think that's sort of appropriate. If you've gotten in the vicinity of where you think you need to be, and you're uncertain about what's next because you don't know if you've done enough, you don't know much about the long and variable lags of monetary policy, you don't know how financial conditions are going to react to what you say and what you do. I think at that point you don't really want to give forward guidance because the forward guidance is probably going to be misleading as opposed to illuminating. So I think it makes sense for them to talk about going meeting to meeting. The only thing I was a little surprised today was that there wasn't much talk about the long and variable lags of monetary policy and the need to slow down the rate of the tightening process. Powell very clearly put the September meeting back on the table. And I was a little surprised by that because the last, meeting was all about the need to slow down and go at a slower pace. And now I find out today that September is a live meeting.
Well, and he was actually pretty blunt on that. Someone asked him specifically, how does this jibe with what you said at the previous meeting? And he basically was like, that's all I'm going to say about that. I'm not going to continue. I'm wondering whether you think it's actually more confusing that there wasn't dissent at a time where there clearly is a range of opinions, and we have a Fed chair just reading the same thing over and over again in response to everyone's questions.
Well, the lack of dissent just means that people are pretty comfortable with the general trajectory of where monetary policy is today, and they're happy about the fact that inflation is coming down, and they're happy about the fact that it's coming down without actually having to really, push up the unemployment rate a lot, at least at this point. I think what's the problem that Powell has created for himself is what do you actually do in September? So in September, you're going to have a couple things. If you decide not to hike, what are you going to show in the summary of economic projection? Are you going to show further rate hikes? If you do show further rate hikes, it's going to raise the question of why didn't you do it in September? Just like what we saw at the last meeting. And if you do hike, then the question is, okay, well, why are you going so much quicker now? And do you show further rate hikes in the summary of economic projections after a September rate hike? So I think he's made it very awkward for himself in terms of tying the projections of what's going to happen in the future to what they actually decide to do in September or decide not to do in September in terms of keeping rates unchanged.
Bill,
so
I think
they've created a bit of confusion. I think it would have been better to stick to the story of monetary policy, long and variable lags. At this point, we're close to where we think we need to be. Therefore, we're going to go more slowly. But he definitely put September back on the table. I mean, he basically talked about the fact that we have two more employment reports until September. We have two more CPI reports before September. So he put the September meeting back on the table more than I would have thought he would have done, given that he talked about the need to go more slowly because of long and variable lags. So I found that a little bit confusing.
Some people frustrated about this September conversation, Bill. I tried to jump in to end it, but we can carry it on if you want. Barry Knapp wrote in, and he said this: questions about whether they hike in September were inane. He went on to say the press conference went poorly, given no questions about fiscal policy working at cross purposes with monetary policy, nor any questions about the deep curve inversion and impact on small banks and the supply of credit. Bill, can we pick up on the first piece just briefly, whether fiscal policy right now is working at cross purposes with monetary policy? Do you think it is?
Well, I don't think fiscal policy is stimulative right now in the sense of the fiscal impulse, but we have very large chronic budget deficits, and those budget deficits are going to continue as far as the eye can see. So the way that plays out is it means that the demand on the pool of savings is higher because the government is taking down so much of the supply of savings. And over the next year, we're going to see a lot more Treasury supply, right? Now that the debt limit crisis is behind us, the Treasury is going to be ramping up their borrowing needs very, very substantially, and the Federal Reserve is going to continue to sell. Is going to continue to let $900 billion a year of Treasuries and mortgage securities throughout. So they've made a tremendous amount of supply, and I think that's going to weigh on the bond market a bit.
Bill, the hallmark of your work at Goldman Sachs ages ago was an optimism about the American economics experiment. The most memorable moment today was Janice Smialek of the New York Times folding in the Barbie movie into a discussion with the chairman of the Federal Reserve about the resiliency of the American economy. To smart guys like you, everybody assembled in the room, everybody in the economics racket, do we just get wrong the resiliency of America?
Well, I think that we have gotten wrong the resiliency of the U.S. consumer. And I think what's driving it is the fact that during the pandemic, there were large fiscal transfers from the federal government to the household sector. And the household sector basically did three things with it. So about a third of it was spent, about a third of it was used to pay down debt, and about a third of it was saved. And so coming out of the pandemic, the household balance sheets were in much better shape than they typically are late in the cycle. And I think that's why the U.S. consumer has been pretty resilient. I mean, I think the point that Gina was making was just that, going to Barbie in a theater is a perfect example of discretionary discretionary consumption. People can decide to do that or not decide to do it. It's not sort of a core necessity. And so the fact that the box office for Barbie and Oppenheimer were so good was sort of evidence from her perspective that the consumer has still got some life in them.
It's a surveillance movie review right there. You got to ask him, did he go? You got to ask him.
Getting Bill Dudley and on Barbie. Tom, if you want to know, you can find out. Bill, did you watch it over the weekend?
No, I went to Mission Impossible. I haven't gone to Barbie or Oppenheimer. That's on my plans, though.
That's in the pipeline.
There we go.
Discretionary spending.
We just learned more there than we did in the press conference.
In the next weekend. Bill, thank you, sir. As always, Bill Dudley, incredibly insightful, lived it at the Federal Reserve as the New York Fed president. If you are just tuning in, welcome to the program this afternoon. Good afternoon to you all. The Federal Reserve hiking interest rates 25 basis points. The Federal Reserve chair saying that he believes monetary policy is restrictive. There was a moment in this news conference when Mike McKee, our good friend and colleague down in Washington, D.C., asked about that. I'm pleased to say that Mike McKee joins us now. Mike, the evidence that policy is restrictive, can you point to it?
Well, he's pointed to the fact that inflation has come down and that the Fed funds rate is now above the CPI in all cases, in both core and headline, and that real interest rates are starting to rise above zero. So they do see some restriction on the economy. But I think one of the key things he said was in his answer to me when he said policy has not been restrictive enough long enough. Now, he doesn't want to put a time frame or a actual number on what restrictive is, but clearly they could be there. They just have to leave it there longer. This was a man who wanted to basically keep his options open and not get tied down to anything at this point.
Mike, what does this 25 basis point move do to our listeners and viewers? I get, and this was alluded to by a number of our guests, big impact a year ago, 2 years ago. What's the impact today of this lift for housing, for food, for the day-to-day life that we have?
Well, it's probably not going to have much of an impact overall in a 25 basis point sense. It's the cumulative amount of tightening that's been done. That's what Jay Powell has been referring to over the last year and a half, where they've gone 550 basis points. Now, what you're looking at is decisions made on interest rates over a period of time. You don't buy a house every day. You don't buy a car every day. You don't spend money investing in a new factory every day. So it does take time for that to work its way into the economy. They don't know how restrictive they have to be. Clearly, they haven't been restrictive enough in the housing sense because home prices have still been rising. But overall, they're getting close to that area. And I don't think that the average American is going to notice really anything different about this 25 basis point move.
Mike, every time the Fed has a meeting, you sit there, you listen to the tenor, the potential snafus, the way that people ask questions. Today you heard a very repetitive, very stick to the script Jay Powell. There was no forward guidance. When was the last time this Federal Reserve gave no forward guidance about what they were planning to do or how they even were thinking about the data that's coming in?
Well, it's been quite some time. The idea today, and I said this before the meeting, was to come in, make as little news as possible. They were locked into raising rates because the market had decided that's what they were going to do, and so the Fed went ahead and did that. And beyond that, they tried basically to leave their options open. Jay Powell was very scripted, as you heard. He did sound more relaxed than he did at the last meeting or the last couple of meetings. So from that standpoint, point, Lisa, you could say maybe the vibe was they're getting close to the end, and I'm not sure at this point that they would raise rates again. But they don't want the markets to walk away from this thinking that they're going to do one thing or another, so they tried not to really give any guidance.
We're covering vibes of news conferences now with Mike McKee. Mike, thank you, sir, down in Washington, D.C. Appreciate it, as always. Here's the runway, the calendar for you. September 20th, the next Federal Reserve decision. Jackson Hole, of course, in between this meeting and the next meeting. For the data, August 4th for payrolls, August 10th for CPI, September 1st for payrolls, September 13th for CPI. So, TK, two of each, CPI and payrolls, going into the next Fed meeting. And you can take away from this meeting, this news conference, whatever you want. That conversation can change very quickly based on two prints of CPI and two prints from payrolls.
Elisa nailed it. She said it's just completely data dependent. I'm going back to that. I don't think there's any theory involved here. I don't think there's any textbooks. That conversation we had before the press conference was just absolutely brilliant on the ambiguities of the moment. Right now, with clarity, because he has to manage money, Jeffrey Rosenberg joins us, portfolio manager of BlackRock's systematic multi-strategy fund. Jeff, my deepest sympathies. You have to have a conviction, a belief forward. What is your conviction now, given the ambiguities we witnessed today? I think we have a little bit of silence here.
They've got to turn his microphone up, TK.
There.
You know,
I don't, you know.
Jeff put it on mute.
They're on mute.
Jeff's got to unmute himself.
But
It's
the
like a Zoom call
ambiguities
gone
here,
bad.
you know, the ambiguities here are important. And John,
Well, you know, that's like when you're in the team meeting and Lisa starts throwing stuff at the screen. It's like, Bravo, you're on mute.
I'm going away tomorrow.
Listen to me.
You know,
And I start like pounding, and then excuse me.
I'm going away tomorrow, and
Are you?
and you
Where
guys are
are you
running
going?
the show. I'm going deep to the Northeast. I'm just going. It's just going to be. I'm going away for months. It's going to be like a sabbatical.
You're taking
like
a month
you have.
off?
Taking a month off.
That
Good
means
for
2
you.
days.
Yeah, and you guys have the former vice chairman of the Fed, and the arch question to Vice Chairman Clarett, I believe, scheduled tomorrow in Bloomberg Surveillance in the mornings. Check it out, folks. And I'm John. I'm sorry. The arch question here is Clarett is saying we're not going back to 2%. We're not going back to 2%. Nobody, and Powell's not talking about it. I don't think anybody else really is. Clarett is out front on that.
I'm with you. The standout call from former Vice Chair Rich Clarett, together with PIMCO, came out in their secular outlook a couple of months ago. And ultimately, it's this underlying belief that they will tolerate higher, above target inflation of 2 point something. You got some indication of that, just a hint of it, when he talks about we're not going to hike until we get to 2%. That's ridiculous. And also, by the way, we don't think we're going to get to 2% until 2025. And within that, I think there is a message, Bramo, that they are willing to tolerate 2 point something because they're willing to tolerate above target inflation from here all the way out to 2025 if the Fed chair's correct.
You know, you pick up a really interesting point because it highlights the uncertainty around long and variable lags. He's saying that if we wait until inflation gets down to 2%, we will have necessarily gone too far. Okay, well then how long do you have to wait before you understand what the ramifications of what you hiked? Is this a concession that you're willing to go to 2.5%? And that is really what people are trying to parse through. Basically, people are shrugging off, viewing this as a non-meeting. That's my view.
We haven't talked about this enough, though, and I think Jean Barvan of BlackRock, congratulations, by the way, for bringing this up repeatedly. What's the appropriate time horizon, the appropriate period to bring inflation back towards 2%? What is it? So one man's tolerance of above target inflation is another man saying, well, actually, we just need longer. And if he says 2025, isn't that just him saying, like, this is going to take a while and I don't want to crush the economy to get there sooner?
Well, I think that that's a great point. I think the Fed said that they're willing to be patient but persistent. At that point, the issue is, will it become a self-fulfilling prophecy at some point?
Exactly.
If inflation becomes
Is there a
higher?
window? That's what you're getting at.
Yes, thank you. I appreciate that. That's helpful.
Well, it's a long day. I feel the way, you know, you can fill in my sentences. You can fill in my sentences as well. I need it sometimes too, Bramo. Is there a window where they need to address this before it becomes embedded?
Right.
You've seen what happened with UPS and what almost happened with Teamsters and the strikes. What are we talking about here? 5% wage hikes? They're not going to be alone, are they?
No, and we're already seeing that pretty much across the board. And people talk about the tight labor market, but that changes
changes the scenario in this profound way. This is the issue that a lot of people are looking at, and yet you're seeing that divide, whether it's Bob Michael or whether it's Jim Bianco.
You see the divide, and the wage thing is critical because a lot of people, they don't parse out unemployment rate, they don't parse out this, that, and the other thing. They are only and singularly looking at wage inflation. Through all this debate, if folks say, what's this meeting like versus the other 10 meetings we had, and I'm going to go to the great observation of Neil Dutta that we finally have a legitimate real wage in this country, and that changes the emotion, the behavior of people, like the bombshell from Drew Mattis earlier this week, really pushing against the gloom we heard from our guest, where he says you got a legitimate real GDP forward. Part of that, John, is a legitimate wage growth, which I don't think is within the debate right now. Inflation worry, we're worried.
Inflation worry.
We're worried.
I'm not worried if I'm getting a pay rise.
We
worry about that. I think, I've always find it weird when economists say, this is uncomfortable. Wages are too high. And like everyone else is just like, there's nothing uncomfortable about this. That's what I want to happen at year end. I want a pay rise.
And we heard Jay Powell really speak to that.
Yeah.
He basically said, we want this. It's a good thing that wages are going up faster than inflation. And yet, is it, if that's the goal, to get down to 2%? This is the conundrum. And he tried to parse it through by actually saying nothing.
Elisa, you and I will try and say something tomorrow morning. We'll be here alone without
Yes.
TK. I think tomorrow there's going to be a conversation about something Mike McKee talked about in the news conference. What's restrictive? And what evidence is there that we are restrictive right now? This is what the chairman said. The FOMC believes monetary policy is restrictive. He did acknowledge that it's not restrictive enough for long enough, so they need to hold it here for some time. But ultimately, if you look at the real Fed funds rate, it's at a meaningfully positive level. Okay, well, what evidence is there of that right now? And I would go one step further. What evidence is there that the disinflation we have seen so far is a consequence of the tightening they've delivered if they believe there are these exceptionally long and variable lags? And I would go to what Neil Dutta said at RenMac during this news conference, and I'll read out what he sent to me privately, but he's happy for me to share it with you all. He said the Fed remains wedded to the long and variable lags hypothesis. After 18 months, we've seen home prices accelerate, stock prices accelerate, auto sales accelerate, and layoffs sink. Long and variable lags is a concept that might be outliving its usefulness. Now, for the same people looking at the same evidence, you can have one individual, Brahma, that turns around to you and says, I think the long and variable lags are a whole lot longer. And someone else can make a different case with the same data and say, you know what, I think they're a whole lot shorter. They just haven't had any effect yet.
And anyone who's looking to the Fed for guidance, forget about it, because they're not going to give you any. And basically what I heard was a chair moving the goalposts, saying, okay, it might be restrictive, but it hasn't been restrictive for long enough. So is this a new criteria that it has to be long enough, that you put that x-axis long enough, and then that will take place? They don't know. So how do they communicate? We don't know. We're experimenting. We're going to look at things.
I think out of this conversation, and this is Ed Hyman, Evercore ISI, and I thought Michael Darda of Roth MKM was just brilliant today on this. There's an entire monetary or money side to this, including something no one talks about anymore, which is M2. I mean, if I was down there with Paula asking a question, I'd say to Chairman, your PhDs tell you at the Fed that M2 doesn't matter anymore, velocity doesn't matter. Europe just announced a crater in loan demand with a slowdown there as well. What's the viscosity right now of the American system? Bob Michael's here. I saw him. He's on his phone doing commercial real estate workouts for Jamie Dimon while he's sitting on set in commercial.
Don't start rumors.
Good morning, Bob. Thanks for being with us.
Bob was fantastic, by the way.
Yeah.
You've teed up Europe quite nicely because
I'm trying.
We shift away
Maybe
from
I
the
should
Federal
cancel
Reserve
my trip.
to cover the ECB.
It's a sabbatical, but I should, Madame Lagarde would like me to be here.
The European Central Bank decision is tomorrow, and it's worth repeating that Germany is in recession. The data is absolutely dreadful, and inflation, Lisa, is still sticky.
And this is the fear. What happens if this ends up being a similar story in the U.S. if inflation reaccelerates and growth slows down? We didn't hear that from Fed Chair Jay Powell. His base case is we avoid a recession and we end up bringing down inflation to 2%. The Goldilocks, he's leaning into that. And yet, yes.
I don't think he's leading the Goldilocks. I think he's worried about Bill Dudley's outlook.
Right.
He's just. They don't want to make a mistake on the upside. They do not want to cut before they're certain. That's the emotion of the discussion.
I asked the question, Tom, earlier, whether the biggest risk right now was cutting too soon or holding too long. And I think
John,
I'm with you.
The biggest risk, if I missed the damn Gulf Stream at Teterboro.
Never mind. I saw him checking the train times.
Well, I think
during
that-
the news conference.
I think Jay Powell was checking the trade schedule at the same time.
He wanted out too.
Yes.
We need out as well. You probably want rid of us. We'll see you tomorrow morning. TK will be gone. Thank you very much for choosing Bloomberg TV and Bloomberg Radio for your Fed coverage. From New York, good afternoon.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it's 3:46 on Wall Street. We do check the markets for you all day long here at Bloomberg. I'm Denise Pellegrini. Stocks are mixed after the Fed spoke. The Fed hiking interest rates. Another quarter point is expected to a range of 5.25 to 5.5. The Fed also, importantly, saying it no longer is forecasting a U.S. recession. Fed Chair Jay Powell does say the Fed may hike or hold, though, when it meets again in September, if data warrants.
Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go.
Long way to go, long way to go, long way to go. That's sort of echoing in investors' minds. And Powell also saying the FOMC still wants to see the easing of supply constraints triggered by the COVID pandemic. And Diane Swunk, chief economist at KPMG, says it's not the data that we'll get between now and September that the Fed is worried about.
The larger issue for the Fed at this point in time is that financial conditions are fighting them a bit. And even though they've got additional quantitative tightening, they've continued that. That's why they're still going forward. And I would argue one step further in that the good news we've gotten on inflation recently further emboldens the Fed to actually get to that 2% target.
We'll see Swank there on our special show, The Fed Decides, that you've been listening to with us here on Bloomberg Markets. And stocks are mixed. The Dow is now up about 0.1%, about 45 points. The S&P 500 down fractionally, down, call it 2 points now. The NASDAQ also down fractionally, down 6. The yield on the 10-year right now slipping just a little bit after the Fed spoke, 3.85%, we'll call it. Spot gold, been higher all day, still higher, up about 0.5% right now, $19.75 an ounce. Crude oil lower today, down 0.9% now, $78.91 a barrel. Shares of Facebook parent Meta, they have been trading higher all day, good by 1.5% or so for much of the day. We'll be getting earnings from Facebook parent Meta after the closing bell, and we will be tracking that live for you here on Bloomberg Markets. And watch for what Meta says about AI and also about Threads, of course, its new Twitter competitor. And Fed Chair Powell was talking about some supply chain issues. Well, there is a cargo ship now carrying nearly 3,000 automobiles, or it was, some made by Mercedes-Benz, but it is on fire off the coast of the Netherlands. Some deaths are being reported as well, and there was a big rescue there as well. And that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, 2023, another Fed FOMC meeting. It is in the books. Carol Master along with Tim Stanovic live here on Bloomberg Business Week. Thanks so much for staying with Bloomberg on TV, on radio, and across our streaming platforms as well, and on YouTube when it comes to the latest Fed decision. And it's interesting to hear what our team had to say, Tim. It feels like we got a little bit of everything, kind of a little bit boring and kind of what we expected.
I think somebody's ready for vacation. You know?
Oh, Jay.
Yeah. You know, he's got 8 weeks until the next meeting of the Federal Reserve. Between now and then, there is a little thing called Jackson Hole. And I wonder if we'll hear any details then. But the fact of the matter is, I mean, one of my big takeaways is that a lot can happen between now and September. And he said that.
Data dependent. They're going to watch it. Every meeting is a live meeting. There's no cadence already cooked in the books, at least on the Fed.
I mean, a live meeting, and he talked about the dissent in this one, and we'll see it in the minutes in 3 weeks. But, you know, it was unanimous for this decision.
I will say one hot take. He doesn't see inflation back at 2% until about 2025.
That's a long time away.
That's a long time away, and that the Fed will not be cutting rates this year.
Higher for longer, anyone?
It's another thing. All right, so let's see what our market guest has to say. Our Drive to the Close guest on this Fed Wednesday is Brian Jacobson, Senior Investment Strategist at Allspring Global Investments, with us on Zoom from Wisconsin. Brian, a lot going on. It feels like a little bit of a ho-hum meeting, and I feel like markets have settled to kind of where they were prior to the Fed decision, if we saw any kind of movement coming off of it. What is the most important thing you heard from Jay
thanks
Powell?
for having me. So now I'm chief economist at Annex Wealth Management here in Elm Grove, Wisconsin. And when I was talking to our investment policy committee prior to this, trying to dissect what it is that Chair Powell was saying, what was really important, it seemed like it was hard to find something important. It was almost as though he was trying to be as non-newsworthy as humanly possible. So I agree with you that he seemed a little tired. Maybe he needs a little vacation, a little R&R before that Jackson Hole trip.
I think I need a little vacation. I'm so sorry about the title mess, so forgive me. So chief economist, and you said, what was the firm?
Yeah, we're at Annex Wealth Management.
Annex Wealth. You guys keep changing things around on us. I'm just going to say.
But it's the same Brian Jacobson we know and
It
love.
is.
So we do love having you on the program. Still joining us from Wisconsin this afternoon, Brian. So what happens between now and September? I mean, how does? Yeah, go ahead.
Yeah, honestly, I think that really this was a hesitant hike. Right. So they had that hawkish hold. Now this is kind of a hesitant hike, like, we're going to do it. Maybe we kind of talked ourselves into a corner of needing to do it. And now perhaps we're in that pregnant pause. I don't see any compelling reason why they needed to upgrade the economic view from modest to moderate, right? So in Fed speak, modest is pretty slow, moderate is slightly better. So I thought it was a little confusing as to why he would upgrade economic activity. And we do get a lot of data between now and September, and I don't think there's going to really be a strong case for a further hike from here.
What though, it's interesting though, in terms of what we got, and if you watch the market reaction, it does feel like we're pretty much where we were. He did also say the idea of hiking rates until inflation is at 2% is way past target. So is he acknowledging, in your view, Brian, that they could overdo it here?
Well, I think that he is trying to remind people that that long and variable legs debate, maybe where it is that he falls on that, which is that they don't have to keep hiking until they hit the target. It would almost be like if you are trying to take a medicine for a headache, and if you keep popping ibuprofen until the headache goes away, you would have overdosed, right? So I think that the idea here is that where they are now is pretty close to what they think could be cruising speed, and as long as inflation continues to sort of choppily move towards 2%, they will be content with that.
As long as inflation continues to move toward 2%.
And that's going to be, I think, the big challenge is between now and, say, the November meeting, we are probably going to see that headline inflation number move higher because we do have higher food and energy prices. So is he going to have to start, again, talking away from the idea that, well, headline inflation, we're not ignoring it, but it is very volatile because it is driven by those volatile components. So it is going to be an interesting conversation as far as perhaps what that September meeting looks like to justify not hiking.
We all have to remember this isn't an exact science, and that's the tricky part that the central bank has to deal with. I did think it was interesting when he said we remain committed to bringing inflation to that 2% goal and keeping it anchored there. And I think that's what's key, and that's why we have to think, Tim, to some extent, this higher for longer, as you were saying before. It's that they've got to make sure that it's not a case of it gets down to 2% and then it pops up again.
What I thought was really interesting, Brian, is that we didn't hear much talk or indeed many questions about what we've seen in the equity market over the last few months, this AI-fueled rally, and whether or not that is indeed financial conditions loosening to an extent that Fed Chair Powell was not comfortable with.
Yeah, it did seem like in previous press conferences, it's almost like some people were baiting him, saying that, the equity markets are moving up, and so what would you have to say about that, right? And so he probably would have batted away some of those questions anyways, perhaps learning from previous mistakes that he really shouldn't comment about market reactions, especially short-term ones. I was glad that people didn't ask about the most recent market moves. It did seem like it was more focused on, sort of that outlook from the Fed. What data are they looking at? And honestly, I came away thinking that their forward guidance is almost worthless because their forward guidance is only as good as their forecasts. And their forecasts haven't really been all that great. You know, if the staff economists are now taking out a recession, we didn't get a lot of data since the last meeting. So what data came in that convinced them that we're not going to necessarily have a recession in the fourth quarter?
Some of the data that I guess that came in is jobs are on average showing what? Monthly jobs reports, more than 200,000 jobs added to the economy every month.
True, but you know, that would have been a collapse in jobs if we would have gotten anything close to, you know, like the 100,000 run rate that might be more consistent with stable, with a stable unemployment rate, or even consistent with labor force growth. And so there really wasn't a lot of data since then. And so if they, maybe what happened is they moved the starting line for the recession out of the fourth quarter and put it more in 2024 instead.
Your next focal point when it comes to the U.S. economy?
I'm really interested in next week. It's the first week of the month, and so it is almost like Christmas for economists. You know, we get the ISM numbers. We also get the employment situation report. The SLOOS is coming out as far as that senior loan officer opinion survey, although he already kind of teased it. It's almost like he gave us an early opening for the gift there to say what that would indicate. But is this divergence between manufacturing and services continuing, or are we finding maybe some stability, some bottoming for manufacturing, so we can transition from a roving recession to more of a stumbling recovery?
Roving recession, hesitant hike, pregnant pause. I'm seeing it's a pattern with alliteration, Brian. Hey, in our last 30 seconds.
I am a sucker for alliteration. It's the large language model that I have in my head.
Hey, I like it. We're going to do a lot of AI on the show a little later today. Very briefly, 20 seconds on the housing market and the way that Powell described more supply coming online.
Yeah, I'm curious about the supply as far as with existing home sales. If we do find stability with mortgage rates, people are eventually going to have to relocate. But from a GDP and growth perspective, it's really about the new housing dynamics. So new housing construction is what contributes to real GDP growth, and that has been taking off.
All right, going to leave it on that note. Listen, thank you so much. Brian Jacobson, Chief Economist at Annex Wealth Management, joining us on Zoom from Wisconsin. You are listening and watching Bloomberg Business Week on Bloomberg Radio, on YouTube, and of course on our streaming service, Bloomberg Originals. Just got a couple of minutes left in today's trading session, and we're just a little bit lower on the S&P and the NASDAQ. Time, though, for Beyond the Bell starts right now.
Full market coverage coming up as we get closer to these closing bells. Stick with us. We're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell, here to help take us beyond the bell. It's a global simulcast with Carol Massar and Tim Stenovic. Welcome to our audiences across our Bloomberg properties, an audience that, of course, was glued to that TV screen at 2 p.m. Eastern Time. 2 p.m. Eastern Time that, I don't know, was a little bit of a letdown.
I know. I feel like I agree. It was a little bit of a ho-hum. I mean, Tim, because I feel like if you look at markets, we're pretty much where we were, maybe even a little bit firmer on the equity side of things, but pretty much where we were prior to the decision.
Yeah, I mean, look, 99% was priced in at 99% level that this would happen. It was what Brian Jacobson, Chief Economist over at Annex Wealth Management, called a hesitant hike. But Romaine, what did you want to see?
I think it was the communication and the guidance. No communication in that statement other than what we've had before. And the press conference was just him basically dodging questions, failing to go out on a limb and tell the market about anything that might come next. And I think this gets to the idea, Scarlett, we were just speaking with Andrew Levin about this idea of, quote, unanimity. I'm putting up my quotation marks here.
Yeah.
There's clearly not unanimity there. And I would rather them be a little bit more transparent about
Yeah, the vigorous debate that we all have in the markets should be something that's reflected in what happens inside the Federal Reserve. I think you're looking for conviction,
where is Jim
and there was no
Bullard
conviction.
and his bicycle when you need him, Scarlett?
You know what? We just have to wait, and I'm sure he'll have plenty to say later on. But it did feel like a choose-your-own-adventure kind of press conference where you can read whatever you want into what he said.
He did tell us wait 3 weeks. Wait 3 weeks until the minutes come out, right?
Well, we got a lot coming up. I mean, 3 weeks till the minutes come out. You have Jackson Hole, August 24th through 26th. You got the next Fed meeting on September 20th, and of course, quite a bit of economic data in between with two big critical labor market reports and at least two critical inflation reports in there as well. Meanwhile, the S&P 500 is going to finish the day little change. The NASDAQ Composite going to finish the day down about 0.1%. The Dow Jones Industrial Average, well, having a pretty good day. 13 straight days of gains, up about 0.2%, a 13-day win streak that matches its longest win streak since its inception more than a century ago. The outperformer, though, on the day belongs to two other indices. The Russell 2000 up 0.7%, and Dow Transports up almost 3%.
Yeah, the world is in love, at least investors, it seems like, with the Dow Jones Industrial Average. Also, if you're looking for some outperformance today, check this out, the KBW Bank Index, which is always interesting to watch on a Fed day. And when we're talking about interest rates, it certainly plays into what banks can charge on their accounts, also what they're getting on loans. But KBW Bank Index, guys, up about 1.9% today.
All right, let's take a look at the industry groups and industry decliners and advancers, because we have a pretty much unchanged market for the S&P 500. But at the top, the best performers here are some railroad companies, Union Pacific leading the transportation index higher, media, entertainment, and banks doing well in addition. And of course, banks have been the big drivers of the Dow's 13-day advance as well. On the downside, software and services, that's Microsoft. Semiconductor companies, that's Texas Instruments. All those on the results just reported.
All right, real quickly, let's get to some of the individual gainers as we wait for those earnings. Alphabet, top of the NASDAQ 100 and S&P 500, up about 5.6%. You know the numbers. We did it yesterday after the close, reporting second quarter results that beat expectations. So the ad business, a lot of analysts weighing in, saying that it does seem to be recovering. Cloud unit benefiting from the rising demand of AI. The Gap, this was there were two stories that had to do with CEOs. Gap getting a new CEO. Thank you, Mattel, because the Mattel president and COO, Richard Dixon, was named as Gap's next CEO. And you did see the Gap show some outperformance, up about 7.7%. Dixon was really key in giving some new life, if you will, to Barbie when it was struggling as a toy a few years ago. Union Pacific, Scarlett mentioned it, #1 in the S&P 500. Headline early this morning, it is tapping its chief operating officer to be its new CEO. We're talking about Jim Vena, excuse me if I mispronounce. This is a company that's been grappling with slowing freight demand and facing some pressures to improve its service. And then PacWest, it lost about 27% yesterday, gained it back today. And this is, of course, as it was being bought by its smaller rival, Bank of California.
All right, I'm here with some of the decliners. Scarlett did a great job summarizing these when you looked at the moving groups earlier. Microsoft down 3.7% on the day today. As you mentioned, it's all because of earnings. Shares falling after the company gave a forecast that showed a continued slowdown in Azure cloud services business. Interestingly enough, Romaine, what you ended up hearing from analysts as a result of these earnings was, hey, show me, the magic with the AI. We didn't see that, according to the analysts, when it came to those earnings yesterday. Texas Instruments.
What if there is no magic, Tim? What happens then?
Then there will be a lot of disappointed investors.
Don't say that.
There has to be
magic.
There has to be magic. Not magic today for Texas Instruments. Worst day in 9 months. Go back to February of 2022, down 5.4%. Company gave a weak forecast for the current quarter. And then Snap, finished the day down 14.2%. It could have been worse, I guess you could say. It was down as much as 20% yesterday after those numbers came out. Revenue outlook came in lower than the lower end, on the lower end of analyst estimates, Romaine.
All right, a quick check of yields before we get to some of the earnings that are set to cross the wire any time now. Typical knee-jerk reaction that we saw right off of the 2 p.m. release of the Fed statement. And as is typical, once Jay Powell started speaking, a lot of those moves reversed. The net result of it were yields, at least on the short end of the curve, moving slightly lower on the day by about 4 basis points on your 2-year yield, 7 basis points on the 5-year yield. The moves were a little bit less dramatic on the longer end of the curve and a slight uptick in yields on your 30-year.
I really wondered, what did we come away with from the Federal Reserve? What was your takeaway?
I think this is the inflection point. It's clear that there is a serious debate here about the effects of their rate hikes so far, whether it's appropriate to end those rate hikes. And obviously, at least based on what the staff submitted, still some concerns here about economic conditions, even though they did revise out those recession expectations.
I got to say, I think what was interesting is that they don't see, Jay Powell says, the Fed does not see that inflation gets back to 2% till at least about 2025. And I just think that lengthens the runway. That was very definitive. If we're wondering how much higher for longer, I felt like he gave us a little bit of a timeline there.
Right, so that means maybe all of next year we're going to see rates above 5%. We won't see
but at the same
Fed
time,
cut
they're not going
rates.
to continue to raise rates until we get to 2%. So at what point do they make that judgment? And there's no rule book on this, right? It's just we'll know it when we see it.
Continue to assess.
Yeah, continue to assess. Yeah, great. How many sort of catchphrases can we pull out of that here? I think we are getting some earnings of crossing the wire. We're expecting Meta, Mattel, Western Union, and quite a few others. Let's start here with Meta Platforms. Those earnings crossing the wire right now. Here's your headline number coming in right now on Meta Platforms. In the second quarter, we're looking at monthly active users on Facebook of about 3 billion. That's basically in line with analyst estimates. EPS coming in at $2.98 versus $2.46 on a year-over-year basis. Revenue in the quarter coming in at about $31.5 billion. That's a slight beat than what the street was looking for here. And their guidance going forward for the third quarter, they're looking at $32 billion to $34.5 billion. That's the range that they're giving. The low end of that range at $32 billion is above the average of street estimates, guys. So at least the knee-jerk response here appears shares up on the back of what looks to be a beat on some of the key metrics.
Well, Alphabet's results boded pretty well for Meta, and especially when you consider that advertising makes up almost 98% of Meta's revenue. So as much as they've changed their company focus, the company name to the metaverse, that's really not a big part of the company at all.
I think what's interesting is, and analysts wanted to watch for any ramping up of costs and metaverse investments. Two things. And if you take a look at their expenses here, fiscal year total expenses of $88 billion to $91 billion. They had seen $86 to $90 billion. So it does look like, you know, a total expenses range of 88 to 91. It does look like maybe they're upping that up a little bit. And so maybe they're going to have to answer some questions as to why, because they've been cutting a lot of workers, about I think a quarter of their workforce.
I mean, it turns out if you cut a quarter of your workforce, you know,
there are costs
your
involved.
costs do go down. One thing I do want to point to in Meta's press release here is what Mark Zuckerberg said. He said, and this is to your point, Scarlett, we had a good quarter. We continue to see strong engagement across our apps, and we have the most exciting roadmap I've seen in a while with Llama 2. I actually don't know what that one is.
One second, guys, before we move on here,
Yeah.
I just want to point out, just to your cost issue here, Carol, that you were raising, they're basically saying that their Reality Labs operating losses are set to increase meaningfully in 2024. And that outlook, according to them, includes about $4 billion of restructuring costs.
Yeah.
So they're explaining it, right?
It goes back to that idea that this is the year of efficiency as well, that they are going to take all the costs that they need to do right now and really put themselves in a position to be leaner so that when the pickup comes, they're ready, that will be amplified.
All right. Meta moving in the after hours, guys, up about 7%. More earnings to come. I know you guys are going to be breaking it down, and we are too on this side. So we're going to call it a wrap, at least for the cross-platform, but more listen to TV, radio, our YouTube channel, as well as streaming, because we've got more to break down. And we will see you again, same time, same place tomorrow.
You're listening to Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
All right, everybody, a bunch of earnings crossing, as we said, Meta just crossing, and we are seeing that stock certainly rally in the aftermarket. It's up about 6.5%. And again, it must have to do with the outlook, because it says third quarter revenue. So we're talking about top line, 32 to 34.5 billion. The estimate on the street was 31.18 billion.
What is interesting is the comment from Romain at the end there that the cost increasing for Reality Labs, which is the metaverse of Meta, and that is what the company's been spending so much money on, at least last year,
right.
What scared away so many investors. That's not scaring away investors today.
No, it's interesting, right? Reality Labs is Meta. It's the VR headsets, right? And exactly, they're saying, sees 2024 Reality Labs operating losses to increase meaningfully. All right, so let's get to it. Certainly keeping an eye on all of these numbers as well is John Ehrlichman. He's co-anchor of Bloomberg Markets on BTV, joining us on the phone from Toronto. John, good to have you here. We are seeing Meta pop in the after hours. What's the number one or two headline that has caught your attention?
That you've got basically, Carol, a couple of solid quarters from Meta after a really sloppy 2022 is interesting. I was thinking back to around this time last year when the company talked about rolling out a new automated ad platform. And ironically, there was a lot of focus on artificial intelligence at the time. You know, last year, given the pressure the company was feeling, they were already starting to build a narrative around cost cutting. And you were just talking about all those cost cutting initiatives and the restructuring charges associated with them. So yes, Wall Street likes the financial discipline on the bottom line. Yes, Wall Street, in reaction to these numbers, likes better than expected performance on the top line. But this is a company that has invested so much in AI and acquired so much AI technology over the last decade. You have to wonder if they could redo it, if they'd leave the meta name out. And, I don't know.
Yeah, I was
leverage the yeah.
John, I was just going to ask you about that because what you kept saying over and over again, and look, what they said in the statement today, it's sort of like in Mark Zuckerberg's first comment in the press release, it's like the metaverse is an afterthought. It's the last thing that it gets a mention, the launch of Quest 3 this fall. Before that, he says he's got the most exciting roadmap that I've seen in a while with Llama 2, that's kind of like the Chat GPT competitor, Threads, we all know what that is, Reels, new AI products in the pipeline, and then he gets to the launch of Quest 3. Should they have not changed the name?
Well, I think that Mark Zuckerberg still wants that meta plan to work, undoubtedly. But I think that there's a real good reason for them to be leveraging AI because everybody is. And it's interesting, like we've got these standout stocks from 2023 and heading into Microsoft's results. The AI hype was tested, and I think we were schooled on the fact that they're still working a lot of that AI into the Microsoft suite of products right now. So there's a bullish view that Microsoft will work some of that technology in, but maybe they're not quite there. Meta is there. Meta has been working all of this into their ad platforms for a long time. And the rollout of a specific platform, which is known as Advantage, was really seen as a potential booster to revenue. And so I think that there were a lot of people who felt that after a solid first quarter, that it shouldn't be a surprise if they could do this. You mentioned, Tim, Reels, and I do think that there's a lot of advertisers out there, you know, whether we're talking as much about Reels as we're talking about, say, a new product like Threads, or certainly what's happening over at TikTok. The bottom line is the fact that they constantly talk about this suite of apps, their family of apps, they can still give a very strong proposition to advertisers on leveraging what they've got.
John, to be fair, if they did not give a better than forecasted or estimate for third quarter revenue, this would be a different story. And we saw those expenses, investors wouldn't be so happy. But because their outlook is upbeat and they're raising their forecast, this is why we're seeing some enthusiasm. So it's basically, look, okay, you guys are spending, we get that, but you're also, look at the top line, you're doing well. You're doing better than we thought.
I think they got a pretty good learning lesson, Carol, last year, and how it feels when you don't deliver. And we know there's a certain amount of math behind
Go back to December,
or
right?
missing or whatever. But you remember when they lost $250 billion in market value just in a snap of the fingers? So I think they learned their lesson, and a lot of this comes down to communication. And you're still seeing a company that wants to spend and retool for the future. You know, Mark Zuckerberg seems obsessed with what Elon Musk is doing too, whether Threads works out or not. He is always trying to compete and stay relevant and all that jazz and focus on the future. But I think for today, they had a lot of easy levers that they could pull. And the fact that the ad environment has changed, we just saw that with Google, right? Like the ad market typically dips early. And between Alphabet and Meta, now we have this view that the ad recovery is showing some signs of life.
So the question is, and this is for, you know, a question for managers everywhere, but also for all the people who were in my LinkedIn feed over the last few months saying that, you know, they, after X number of years at Meta, I no longer have a job. I'm now open to work. The tens of thousands of people that the company laid off. To what extent can we attribute this success to decreasing those costs?
Oh, 100%, Tim. I mean, the reality is that this is a company that grew because it had the opportunity to grow. And I think The reason I brought up the same quarter a year ago and the company talking about introducing updated versions of their ad tools, well, because even their messaging then alluded to the fact that AI would allow them to do more with less. So I think it's a pretty sobering time still at the company, given how many people, and when you lose your colleagues, that's not fun. And at the same time, we're sitting here on a day where maybe, the headline is that maybe we don't see the recessionary environment that anybody thought. Tech overspent, tech overhired, and I think the fact that AI is as advanced as it is allows these companies to do more with less. So 100% it plays a key role there. As for the stock market reaction, this is an interesting one because this is the second best performer in the S&P this year, right behind NVIDIA. I mean, literally, this is like 145% coming into the earnings report, but this is still a stock that has a long way to go to get back to its all-time highs. So
right, still down about 22% from that September 2021 high. And we talk about it, we wrote about it, on the Bloomberg too, John, as you know, that with a PE of about 26, I mean, its valuation, as our writers reported, might be at saving grace, because if you look at some of the other big mega cap tech names, they have run up so much, but their valuation has gotten really heady. And so you're even, so maybe that's their saving grace, that they weren't so overvalued, perhaps.
I think so. And already you're going to be seeing these headlines about this being, a return to profitability for the company. And I think that they are definitely going to leverage in the short term. But I still think there's plenty of issues that this company has to deal with. I think, let's just talk about the landscape of social media. It's hard to gauge how TikTok is doing every day, but they're definitely giving Facebook's, or Meta, I should say, properties a run for their money. So they're always having to navigate that. We haven't heard any updates on the Elon Musk, Mark Zuckerberg cage match, but we've definitely seen Threads launched. It'll be interesting to see if they have any more data on how that is doing so far. And that is a bit of a risk for the company to take. You've got Elon Musk now creating an everything app at a time when some people have said Zuckerberg could continue doing the exact same thing because they own WhatsApp and this family of apps, and Facebook itself has tried to be a bigger player in payments in the past as well. So there's a lot on the go, and I don't think there's any shortage of competition or easy answers going forward. But this has always been that company that has sucked up so much advertising revenue and pulling some levers again to show their muscle.
Well, the stock, which was up more than 7% in the aftermarket, still up about 4% here, but definitely tempering some of the gains back, but we'll continue to monitor it. Chipotle also out with their numbers. Second quarter revenue, a very slight miss. Comp sales were a slight miss as well. Second quarter adjusted EPS was a beat, and we're seeing that stock under some pressure in the aftermarket, down about almost 6-7%. Lam Research, meanwhile, up about 2.5% in the aftermarket following its earnings, and it came out, with its results. All right, John Ehrlichman, thank you so much. You're listening and watching Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it's 4:21 on Wall Street. A lot going on. We check the markets for you all day long here at Bloomberg. I'm Denise Pellegrini. Let's start with Facebook parent Meta. Shares up significantly, up about 4% right now in the after hours. Meta out with second quarter revenue. It beat estimates, particularly that advertising revenue up more than expected. Also in tech, some developments for Alphabet's Waymo unit. It says it is slowing development of autonomous trucks, so we're tracking that for you as well. The Fed today raising interest rates a quarter point as expected. Fed Chair Jay Powell saying the FOMC no longer forecasting inflation. That's important. But also telling reporters it's possible the Fed might hike rates again in September, depending on that data. The Dow finishing up about 0.2%, 82 points higher. The S&P and NASDAQ, though lower, the S&P 500 down fractionally. The NASDAQ down about 0.1%, down 17 points. The yield on the 10-year Treasury, 3.86%. Spot gold higher all day, up about 0.4%, 1973 an ounce. NYMEX crude lower, down by about 0.9% for most of the day. Shares of Chipotle, they are lower in the after-hours session after they reported quarterly results. And Mattel reported adjusted earnings per share for the second quarter that beat the average analyst estimate, but its forecast for the year not really giving us that let's go party Barbie kind of vibe for some investors apparently. And shares of the Barbie maker guys, they are in the red, in the pink right now in the after hours session. And that's a Bloomberg Business Flash. Carolyn.
Nicely done. Denise Pellegrini, thank you so much. Carol Massar along with Tim Stanovic live here on Bloomberg Business Week. Meta, as you know, just out with earnings as well. Denise breaking down all those results after the close. Stock's still up about almost 5% in the aftermarket, but it's off its pop that we saw of about maybe 6-7% just after it reported. You had Microsoft and Alphabet and Snap last night, Texas Instruments. So let's go over that, what we've gotten so far from tech mega caps and earnings this week and in this earnings season. Back with us is James Chakmak, partner and technology analyst at Clockwise Capital. He is on Zoom in Miami. James, so good to have you back with Tim and me. So Meta, let's kick it off with Meta. It's up about 5% in the aftermarket. Does it make sense, the trade, and what do you like about the results, or not like?
No, I think the results were great. I think the aftermarket reaction speaks for itself. I think it's a tale of two cities when you look at Meta on the one side and Snapchat on the other. I think that what you're going to see is that these big ad platforms continue to accrue more and more value and more of the online digital ad market as they implement their AI capabilities and invest on that front. So I think it's going to be increasingly hard for the niche players unless they have some type of completely differentiated value proposition.
Are they actually
can extract the maximum value out of each user.
James, good to talk to you, by the way. It's been a while.
Sure. Yeah.
Are they actually implementing this AI technology yet? Because if you look at some of the notes today in the wake of Microsoft earnings, this is Microsoft, and we can talk about Meta too. It was, they were like, show us where the AI capability is.
It's going to take time. Let's be fair, right?
Yeah, I mean, look, I think it's going to be a constant state of iteration in getting the right ad in front of the right user at the right time. And that's been the mission of digital ads since day one. As dollars move from analog to digital, that's the golden value proposition that they're selling. They're just going to be able to get better at it. But also on the flip side, as you think about the generative AI aspects of it in the production of ads, there's a lot of money spent being toward the middlemen in the creation of these ads. And think about being able to create 1,000 ads in several seconds, tailored toward every type of constituency that you can think of. And where are you going to deploy that excess capital that you would have spent on that front? You're likely going to deploy it toward the advertising themselves. So they, in essence, it's not just Meta specific. I think as the industry adopts these tools and capabilities, I think that you'll see more and more dollars shift toward these platforms.
What I find always kind of wild is the reach of Meta as a company overall. And I'm looking at Facebook users topping 3 billion. I mean, that's real numbers, whether you like it or not, and it's up 3%. Like, that is worth something, correct?
Yeah, it is. But at the end of the day, you still have to place a value on it. We actually, we trimmed our position around 300. We were up about 100% on it heading into the print because some of the buy side expectations have gotten, out of control, looking for 10% higher numbers than where the street currently is. And you saw those disappointments on the buy side getting ahead of themselves on Netflix, on Microsoft, as well as on Tesla. So, in handicapping for that, we did take some money off the table. And then this is go ahead.
Yeah, well, no, you go ahead, James, and then I'll follow up.
Well, I was just going to say, also investors are really rethinking how they're valuing these companies. As the investments on the AI front require a lot of capital expenditures. So a lot of the valuation methodologies have increasingly shifted from an earnings basis to a free cash flow basis. And that's kind of changing the valuation calculus as well.
What about TikTok? You look at time spent on these apps.
Yeah.
And you look at where the eyeballs are and how much time they're spending using these. What's the TikTok factor here for meta platforms?
I think it's a factor for all of them because time is finite. Every minute I spend on this service is a minute not spent on another. I mean, we're cognizant of it when it comes to Meta, when it comes to Alphabet, when it comes to Spotify, and any type of media consumption.
Right?
Netflix,
Any
exactly.
Yeah,
I mean, you got to be cognizant of it, and we're only here once in this world for only a certain number of minutes, and whoever can capture most.
Wow, that got existential very quickly, James.
It's funny that you say that because Tim and I recently had a conversation. This whole idea of you're right, like you have a limited amount of time on this earth.
I know. You know what's funny though is like, do I really want to be spending the limited time I have on this earth glued to my phone?
Exactly, right? I mean, it's really, I do think there's a major rethink going on. And we all just have so much time. And, I went back to reading and I'm like, I forgot how much I love books. You talked to me about reading and going back.
Like real books.
Like real books.
Yeah.
Snap, did we talk about Snap?
We didn't talk about Snap with James yet.
Are we just writing this one off? It just seems like quarter after quarter, it's a little difficult.
Yes. Yeah, I mean, it's simply untruth. Yes.
You've been covering Snap for years, James. What's going on?
Yeah, I know. Well, the thing that he sold me on a different value proposition than what it ended up being, which is why I was initially constructive on it. But the problem with Snap is, they don't really know what they are. This is in order to succeed, you either have to be everything to everyone, and then to be that, you have to have massive scale, like a Meta, like a YouTube, or you have to be incredibly niche and maximize the average value per user by a tremendous amount of engagement on a per user level. Unfortunately, they're trying to be a Meta without the scale of Meta, and that's a losing proposition. And I just don't see they contrast that with a Pinterest, which is a different value proposition, one that necessitates a different level of engagement, an aspirational level of engagement. Those are two both niche services, but one is better than the other.
So I'm looking at just a bunch of earnings in the aftermarket. I mean, we just talked about Meta in a big way and some of the other big tech this week, but you got Chipotle down about 8%. The company's saying inflation hit some popular menu items. We've gone through bank earnings. We've gotten some chip names. I mean, what are you thinking about this earnings season so far?
It's a good question. I mean, we're actually broadening out our portfolio. Obviously, we're tech first. We're called Clockwise Capital because we believe the purpose of technology is to save time, i.e. productivity. And, that's what we look to invest in, big secular themes. However, we've had a tremendous run. A vast majority of the growth that we've seen or the appreciation in the market has been a factor of the multiple expansion versus earnings expansion. So actually, we've added a lot of names that are, not traditionally tech, into our wheelhouse. We've added Coke, we added Spirit Aerosystems, we're in JP Morgan, Standard & Poor's, a lot of names that you wouldn't really think because we think that there's going to be a rotation here from growth to value as things settle down on the growth side. But obviously still full steam ahead on the big names like Amazon and NVIDIA.
I love what you said, and I think this is like something worth repeating, that the appreciation of the market was because of multiple expansion, not earnings expansion. Like when we talk about the importance of fundamentals, this is why earnings matter, right? When we go through the earnings season, to see whether or not, especially some of these names that have run up so dramatically, whether or not they, are worth the valuation that we see in the marketplace.
So James, just in the last minute,
the biggest
Yeah, go ahead.
I was just going to say on that point, the biggest disconnect in the market between earnings and multiple expansion is NVIDIA. NVIDIA has lagged from an earnings standpoint, from a multiple standpoint, while their earnings have surged. So, I mean, that's why we're putting our money there.
Interesting.
Okay, last minute. Next week, we've got Apple and Amazon. Give us some expectations there.
Yeah, Apple is one that I can't believe we didn't add it to the portfolio. It's one that we just didn't see that much upside to it, and it's worked. But I think that Apple's going to be just fine. I think that the expectations around phones and desktop and everything is modest. Services continues to grow. Now, obviously, China is a question mark. And that was one of the reasons why we didn't invest, given the concentration there. But I think the shares should continue to do well. And as it relates to Amazon, that's one that we continue to like a lot. I think that you're going to see the bottoming out of AWS potentially coming out slightly ahead of the 10% growth that the street's expecting, and then possible reacceleration as you look into third quarter. And I think that in and of itself should be enough to send shares higher. Looking forward to get to 150 by the end of the year.
Always love getting time with you. James Bewell, James Chakmak, partner and technology analyst at Clockwise Capital. Really a nice overview of the tech and some of the big names that we've gotten, but also the broader perspective when it comes to earnings and what we've seen in terms of the market reaction. He, of course, was joining us on Zoom from Miami.
Well, let's get a check of the latest world and national news. We're not going back to Miami. We're going to Washington, D.C. to our 99.1 newsroom, where we find Nancy Lyons. Hey, Nancy.
Hey, Tim. Today's court appearance for Hunter Biden did not end as planned. He was expected to plead guilty to 2 misdemeanor tax crimes committed in 2017 and 2018, and then enter into an agreement with federal prosecutors to avoid prison on a charge for possessing a gun while addicted to an illegal drug. But Bloomberg Law host June Grasso says the judge questioned the terms of the deal, specifically concerning any future charges.
There are other avenues that the special prosecutor may want to pursue against Hunter Biden, and his attorneys don't want him to sign it naturally unless he has immunity for any of those past tax crimes.
Bloomberg's June Grasso. Hunter Biden ended up pleading not guilty, with the plea deal now on hold. Rudy Giuliani is admitting to making false statements about 2 Georgia election workers who've been the target of conspiracy theories about the 2020 count.
The former New York City mayor and ex-Trump attorney made the concession in a late-night court filing in the case of Ruby Freeman and Shay Moss. They have accused Giuliani of directing a defamatory campaign against them with false accusations of election fraud to secure President Biden's win in Georgia. The women were formally cleared of wrongdoing last month, but they say they have been subject to months of threats and harassment. Giuliani's filing says he'll no longer contest their claims, but he could still argue his statements were protected under the First Amendment. In Washington, I'm Nathan Hager, Bloomberg Radio.
4 civilians, 2 firefighters were hurt earlier today following a fire and eventual crane collapse in Midtown Manhattan. Deputy Fire Commissioner Joseph Pfeiffer says the intense heat from the fire was the issue. He says structural engineers are examining the building that was damaged by the collapsing crane. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it's 4:40 on Wall Street. We check the markets for you all day long here at Bloomberg. I'm Denise Pellegrini. We had a mixed finish for stocks after the Fed raised interest rates. We're keeping close track of Facebook parent Meta shares. They are higher by about 4% right now in the after-hours session. Meta out with second quarter revenue that beat estimates. Advertising revenue, guys, up more than expected. That's another thing to watch for there. And the Fed today raising interest rates a quarter point as expected, saying the FOMC is no longer forecasting inflation. That's also key. But Jay Powell also telling reporters it's possible the Fed might hike again in September.
We're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting.
That's how Jay Powell is thinking about the next meeting. But Diane Swank, chief economist at KPMG, says it's not data we'll get between now and September that the Fed is worried about.
They're worried about the end of the year seeing a potential acceleration and that it's a bumpy sort of ride down to 2% and that we go in fits and starts, and some of those mean an acceleration back up again, and that's what they're worried about.
And that's Diane Swank with us there on Bloomberg, the Fed Decides. Here's that mixed finish for stocks. The Dow up about 0.2%, about 82 points. The S&P 500 down fractionally. NASDAQ down 0.1%, 62 points. Yield on the 10-year, 3.86%. Spot gold higher all day, up about 0.4% right now, $19.72 an ounce. And NYMEX crude lower, down about 0.9%, 0.8%, we'll call it, for most of the day. Chipotle shares down just about 8% in the after hours after reporting results. eBay sees third quarter net revenue somewhat higher than expected, at least at the high end of the range, but that stock is fluctuating. Mattel reporting adjusted earnings per share for the second quarter that beat the average analyst estimate, but the Barbie maker forecast for the year maybe kind of giving a pale pink vibe, not really wowing investors the way maybe some of them hoped. And shares are down in the after-hours session. And that's a Bloomberg Business Flash. Carol and Tim.
Barbie always comes back. She's strong.
Can she bring that energy to Gap? That's the question.
That's exactly right. We will see as Mr.
Gap's
Dixon moves over, right?
Barbie energy.
Yeah, it really does. All right.
Let's see this transition.
Speaking of somebody who always gives energy to all that he does, mic drop, Elon Musk. And we've been talking about him since the weekend.
I thought you were going to say Jenny Serene.
Well, all right, that too.
She's got great energy.
Now I feel like I failed everybody. She does have great energy. She's also got a most read story on the Bloomberg, and it's about Elon Musk, what he's up to, and looking to go after, the king of Wall Street, Jamie Dimon. Right?
Okay, come on. We've heard him talking about this for years, Jenny. I love this piece because he really did a deep dive into what X means, and he tried to, translate what we heard from Twitter's new CEO in a tweet recently about the future of X, which sounds like it's going to tie us all together in everything.
Yeah, I think that's exactly right. I think they would like it to be the super app. And we've seen a lot of tech giants want to achieve similar ambitions, and it's been hard. It's really hard in the U.S. to pull off. So we'll see. They've got lofty goals, and our story today was really just trying to show it's a lot harder than you think to do this here.
Yeah, I'd like to be 5'9" and living on an island, but hey, here I am. We all have lofty ambitions.
Well, I'm glad you said it's difficult in the U.S. because what they're trying to do is essentially create, a WeChat or a Chinese super app here in the U.S.
Yeah, it's a very different market. Over in China, consumers have shown this willingness to do their banking, to do their shopping, to do their social media, to do all their messaging, all in one app. And so you've got these big super apps like Alipay and WeChat Pay that have billions of users, literally. And so we've seen a ton of different tech giants here think, well, if it's so successful in China, let's try this model here. And so that's really what we think we're hearing from the folks over at Twitter, now X. I think our story today was really just trying to show that a lot of different U.S. tech giants have tried to pull this off, and U.S. consumers just seem to show a different willingness. Like, they really prefer to have things kind of compartmentalized. You do your banking with a bank, you do your social media with a social media company, and you do your, commerce with an Amazon or a retailer. And so they just haven't shown this willingness to kind of bleed through those lines.
Well, I was thinking about this. It's because it's just the way we've always done it, right? And I think about, they always talk about emerging markets. If you want to see financial innovation, go look at an emerging market, because they just started out differently, and we've got to kind of deal with a legacy financial system of how we operate.
Yeah, no, I think that's actually exactly right. In a lot of the cases where super apps have taken off in places like India or China, they haven't had the credit card usage that we have here. And so we find it relatively easy to send payments and make payments. Other places don't. And so we're not really trying to fix anything. We're just trying to bring kind of the latest and greatest, versus other countries that really had huge, giant problems to actually fix with how payments were done.
Can we talk about what some of the other big tech behemoths have done? Because you might know them, Meta Platforms, Alphabet, Amazon, what they've tried to do and not been really able to do it yet.
Yeah, no, I mean, I think Google is a great example of, they got really far down this path. They had even lined up, almost a dozen bank partners. Citigroup was one of them. They had spent months on the project, had talked about it very publicly, and really tried to prime the pump for how much usage this was going to get and how great it was going to be. And then at the very last minute, they kind of said, you know what, this isn't going to work. We're going in a different direction. So you've seen really big, ambitious, Meta with the Libra a few years ago, they were going to revolutionize remittances and change the way we send money overseas, and immediately faced a lot of regulatory pushback. All their partners abandoned the project, and now they're out. And so I think it's just a lot harder. It looks like a really attractive space, financial services, to get into. You've got these really sticky consumers that use them a lot. Like, you use your credit card every day.
Right.
But it's just a lot harder
to become loyal to banking names.
So, Jenny, you put this tweet. Sorry, what is it called now? An X? You put an X?
Yeah. Just doesn't. We're still calling it a tweet.
Okay, I'm going to call it a tweet. You put this tweet in your piece, and it's from Linda Yaccarino, the new CEO of Twitter, who writes, quote, "X is the future state of unlimited interactivity, centered in audio, video, messaging, payment/banking, creating a global marketplace for ideas, goods, services, and opportunities powered by AI. X will connect us all in ways we're just beginning to imagine."
Brought to you by Twitter X, Tesla marketing.
I think someone sent me this tweet like a couple weeks ago when she sent it, or last week. And it was like a meme from Succession in season 3, or no, the most recent season, where they're all sitting around, where it's like, it's Masterclass meets the New Yorker meets the New York Times meets Bloomberg, and that's like what is she saying here?
I mean, that is a lot of buzzwords in one tweet. I do think they're trying to get at the idea that they want to be kind of this one-stop shop for folks. So yes, there's a lot of other elements of that in there, but I think they want to be the place that you go to not just send your tweets or do your kind of basic social media stuff. They want to be where you go for messaging. They want to be where you go for payments. They want to be where you go for shopping, things like that. So I think that's the goal. Yes, a lot of people have probably teased her for that tweet.
Can I say one thing, though? Elon Musk is kind of not completely a financial virgin, if you will, right? If you go PayPal, very successful. And I do think we're all getting to a point. We just talked about, I know, that I just think it works. But we're also at a time where we're also inundated by apps and stuff that if somebody can give me one, I would be kind of happy.
So, yes.
Sorry about the financial virgin.
That's okay, Carol.
But it works. He's not one.
Elon was a founder of PayPal, and I think it's actually a really good point. He does know this space really well. He's since watched PayPal and all of its triumphs and tribulations. I think 2 years ago is really actually a good time to look at PayPal, because they actually said exactly that. They said, we feel app fatigue. We are going to be the next super app in the U.S. We think we can do it mainly because we come from a position of finance. Consumers already trust us with their money. So we have this really good leg up on the Googles or the Facebooks or the Apples of the world. We're going to do this. 2 years on, they have seen their stock completely slump, mostly because people felt like they got too distracted. You now have CEO Dan Schulman talking constantly about, really focusing on the core checkout button and that core checkout experience, completely retrenching from all their ambitions and super appdom. And so, Yeah, I mean, I think PayPal is a good example because one, it shows that Elon has the kind of payments chops that it might take, but also PayPal has gone here and has decided it wasn't worth it. So you kind of have to take both sides of that example.
He doesn't mind breaking things up either.
No,
and breaking things, if you will. He's certainly done it in the auto industry, in the EV world.
Yeah. But in finance, you can't do that. It's a little bit different.
Regulatory framework.
And people's money. I mean, cars are important too. I shouldn't say that.
Jenny, thank you so much, Jenny Saray.
Your company news headlines on Bloomberg Radio.
And from Bloomberg World Headquarters, I'm Denise Pellegrini. We're tracking shares of Meta for you. Facebook parent reporting stronger than expected revenue. Shares are higher in the after-hours session. Boeing's cash pile is soaring meantime. And Bloomberg's Tom Busby takes a closer look at what's happening for us.
Denise, the plane maker generated a surprise $2.5 billion in free cash flow in the second quarter. That's thanks to a flurry of jet deliveries and customer deposits, which helped overcome the extra costs of supplier glitches. More positive news as well. Boeing beat on revenue and earnings and says it's starting to raise output of its 737 jetliners to a 38-jet monthly rate. That's 23% higher than the previous manufacturing pace. Denise?
All right, thank you, Tom. And Boeing shares closed just about 9% higher on that move. Some bad news, though, if you have your eye on a new electric Porsche. Bloomberg's Courtney Donahoe explains that one.
Denise, the part shortage at the luxury car maker not yet in the rearview mirror. Porsche says supply chain problems that hurt output of its only fully electric vehicle will persist in the second half and says meeting its EV sales target of at least 12% of shipments this year may prove challenging. All this as Porsche eyes the rollout of several new EVs. It has plans for an all-electric version of its Macan SUV next year, followed by battery versions of the 718 Roadster and Cayenne SUV. And a top-end luxury SUV is supposed to follow. Denise?
All right, thank you, Courtney. Bloomberg's Courtney Donahoe reporting, and those are some of the company stories we are following for you this hour. I'm Denise Pellegrini. This is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenovec on Bloomberg Radio.
It is Bloomberg Business Week on this Wednesday afternoon, this Fed Wednesday. Let's get a check on the latest world and national news. For that, we go to Nancy Lyons in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. It is a not guilty plea from Hunter Biden after a plea deal with federal prosecutors broke down during today's court hearing in Delaware. The judge questioned the agreement under which the president's son would admit guilt to tax violations and undergo a diversion program to avoid a felony gun charge. But there was a dispute in court over whether the initial agreement gave him protection against any future charges. The plea deal is now on hold. Secretary of Homeland Security Alejandro Mayorkas has had a tough day of testimony before a House committee. As Bloomberg's Irv Chapman reports, some Republican members are even calling for his impeachment.
Congressman Ken Buck put it this way: my constituents consider you a traitor. Buck blamed Mayorkas for the fentanyl that killed Coloradans. Congressman Tom McClintock said Mayorkas allowed hitmen of the Mexican cartels into the country.
We are in growing danger of a coordinated terrorist attack because of your policies. Have you given any thought to how you're going to explain yourself when that happens?
Congressman, the safety and security of the American people is our highest priority.
Obviously, it is not your highest priority.
It most certainly is, Congressman.
Both sides agreed immigration law is broken, but not on how they would rewrite it. In Washington, Irv Chapman, Bloomberg Radio.
Just a day after reaching a tentative deal to boost pay and benefits for hundreds of thousands of UPS workers, the head of the Teamsters Union, Sean O'Brien, says they're now taking aim at Amazon. He tells Bloomberg the pandemic showed companies the value of good employees, and that gives unions some leverage.
Right now, we have the ability to really showcase and be the model and encourage other unions to stand up and fight.
O'Brien says the Teamsters have put some energy into the labor movement. Actor Kevin Spacey has been found not guilty in his sexual assault trial in London. He faced 9 charges in connection with alleged encounters with 4 men from 2001 to 2013. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Tim and Carol.
All right, Nance, thank you so much. Carol Masser along with Tim Stenovec here on Bloomberg Business Week. What do you want to talk about?
I want to talk about celeb news. Celebrity news.
What do you want to talk about?
I don't know. You catch me up on all the, I don't even know who the celebrities are these days. And,
I know.
Like who's who, and you have to tell me.
Can I just tell you, everybody? He just oh, wait, that's Ted Lasso,
yeah,
right?
That's why I'm saying that. Yeah.
Okay.
Yeah, I guess I know the Ted Lasso guy.
All right.
He's great.
Do you want to talk about MasterCard?
Yeah, let's talk a little bit about MasterCard. This is an interesting story. MasterCard demands a shutdown of marijuana buys on its debit cards.
I love how you go for it. So serious.
It's true, though, because if you think about this from the perspective of financial services, Carol, we've been talking about this for years. And it's the way that if marijuana is something that is federally not allowed, it's exempt from our banking system, right?
Come on. I almost feel sorry for the industry. If Matt Miller was here, he'd be going crazy.
He's our Bloomberg Radio
ambassador,
marijuana correspondent.
Yeah, he is. But I mean, you've got these stores selling, right? And it doesn't go through the financial system hasn't recognized it, or because we don't have the federal law, basically, and infrastructure over it.
So MasterCard has told payment processors and banks to stop allowing marijuana transactions on debit cards. Yeah. So I've shared this story before. There's where I grew up